Let's move on. Let's talk about the state of the economy post the big bazooka coming in from the RBI. It almost is seeming like a picture perfect scenario right now with lower interest rates, monsoons being on time and above normal at that, or before time, I should say, in some parts of the country. And of course, lower EMI, lower interest rates, the equity markets buoyant. Let's chat about all this. We've got Aurodeep Nandi, India economist at Nomura, joining in on the show right now. Aurodeep, so great to have you today on the show. Thank you so much for your time. Aurodeep, a 50 bips rate cut. Tell me how much and what gives you confidence of 2 more rate cuts in the calendar year 25? And do you think that's going to happen?
So one, 50 basis points is unorthodox, right? Typically, you would do these kind of rate cuts when there is a growth emergency and there is a need for monetary policy to readjust itself soon. So, 50 basis points cut to commit to getting CRR down to 3%. These are typically sort of emergency level initiatives that are taken. So it is a little puzzling that the RBI has done this. And I think what's also interesting is the change in stance. So it was neutral earlier. In April, it was turned to accommodative, and then probably in the fastest flip-flop we've seen in a while, it's gone back to neutral. Now, all of these developments, and with Governor Malhotra essentially saying that we don't have any more space, or we have very little space currently, it sets the bar really high for an August cut, right? Because you already delivered so much, and it makes sense now to sort of see where policy transmission leads you to. Now the question is this the end, or is there more to come, right? And then that boils down to what your macro outlook is. Now, broadly speaking, our view is that on GDP growth, we will undershoot the RBI's projection. So RBI is projecting 6.5%. Our projection is 6.2%. Even on inflation, we think there's going to be an undershoot. RBI is projecting 3.7% for FY26. Our number is around 3.3%. So there's going to be an undershoot on growth, undershoot on inflation, which actually means that there is A, space to cut, and B, there is need to bring policy not just at neutral levels, but also to accommodative levels. So, we did some simulations with what is known as the theoretical framework called Taylor rule, and we actually see rates moving even lower, which is why we have 2 more rate cuts penciled in, not in August, but in October and December.
Not in October, not in August for the rate cut expectation, because yes, or this time the key word that the RBI has been using was actually the front loading. But Aurodeep, I just wanted to have your take on inflation. Believe that your inflation forecast stands at 3.3%, which is below the RBI estimate of 3.7%. You did touch upon this factor, but what's giving you that comfort to have a difference of 40 basis points between your estimates and the RBI's estimate? Which segment do you believe will help this number to keep it lower? Maybe it's food inflation or anything else. And along with that, already a new CPI series is expected to be published from the first quarter of 2026. So what changes do you expect there?
Okay, so that's 2 questions. So let's address the first one. In terms of why we think inflation is going to be lower, look at the starting point. I mean, we are expecting, in fact, the next CPI print, which is going to come out this week, is going to be below 3%. Our forecast is 2.8%. So one, your starting point is pretty low. On the food inflation side, you have pretty good Rabi crop production because we had good monsoons last year. So food inflation has been climbing down. It's not just vegetables, it's also pulses, which has been, if you look at the pulses series, you'll see there's negative month-on-month growth rate. Almost, for months ago. And so if you look at the food components, it seems like is a broad-based slowdown in inflation that you're seeing on a month-on-month basis. If the expectation is that monsoons will be fine this year, again, that should eventually be a positive for food prices. So one is on the demand supply side, it's positive. On the food side, on the core inflation side, core inflation has been actually relatively weak for almost a year and a half now. We are barely seeing much sequential momentum there, and this could be a mix of a lot of factors. It could be weak demand, could be the impact of cheaper Chinese imports, it could be lower commodity prices globally. So a mix of those factors. We expect actually core inflation will remain range bound through FY26, which is where we are seeing the inflation dynamics actually undershoot the RBI's 3.7%. Mind you, even 3.7% is a sharp cut from RBI's own projection in the April policy, which, unless I'm mistaken, was around 4% or so. So there is scope for inflation to actually be lower than what the RBI is currently projecting. In terms of the new CPI series, look, it's difficult to say because there could be new ways of capturing data. So, for instance, the way the ministry captures, say, house rent or say airline fares could be different. I mean, there are reports that the government may be tapping into online sources of data. So, I mean, that is that's a black box as of now. I think once we get that series, it will be interesting to see if there are some categories that are taken out because it's no longer relevant, some categories coming in, how they are how they're collecting data for the various categories. And I think it would help then to kind of do a back testing of, okay, with this CPI basket, how would inflation be in the past, and then where is it tracking now? So I guess we'll do that exercise when it comes. But as of now, we have to peg policy based on the current CPI basket.
Aurodeep, hi, this is Nehi also joining in. I want to address the liquidity concern that we're seeing in the economy, because if you take the present case scenario, everything looks good on paper. You have inflation that's under control. We're expecting a good monsoon. Liquidity in terms of money supply looks robust right now. But along with this 50 bips cut, we've also seen 100 bips slash in the CRR. Do you believe this could perhaps lead to a situation where we have excess liquidity in the system and then the RBI might have to step in with actions to soak up some of it?
I mean, look, there are a lot of scenarios that can happen. I mean, the counter to this is that the RBI also has a net short FX forward book, which when if it needs to kind of take care of that, that would counter the liquidity that is being infused from the CRR side. So the CRR cut is going to bring in around 2.5 trillion rupees, and actually the amount of liquidity that has come into the system but from the RBI side is pretty large. It's almost, you can start comparing it to the amount of liquidity that came in during the pandemic level. So I don't think there is a debate in the fact that the RBI is trying to make liquidity flush in the system to bring rates down and then in the process sort of help credit growth pick up. So I think that seems to be the broad strategy. I think the issue of whether liquidity is more or less will depend on sort of the durable driver to and fro of liquidity, and also sort of how much the transmission goes through. So best case scenario, RBI front loads so much of easing, it passes through the system and credit growth picks up. And then, this is a successful experiment.
To the other conjecture and the other that you were making, Aurodeep, as to why so much front loading. Do you think it also could be a hedge against just purely tariffs and the repercussions of it all, or do you think it could be something domestic too?
I mean, it's difficult to say, because what Governor said was that, look, our aspirational growth rate is 8%, we are 6.5%, so we should be doing it. Now, the argument economists are generally used to is potential growth being, whether your current growth is above or below potential growth, which in the case of India would be around 6.5% to 7%. Look, I think the ambition out here seems to be that let's front load and then let's push transmission through and then hope that the credit growth picks up. I think what is slightly worrisome on the margin is that if indeed growth doesn't respond well, it could be because of domestic reasons, it could be, as you said, tariff-related global reasons, then the RBI will again have to look into its arsenal and see, okay, what do I have left to sort of again attack growth, which is sort of where our idea is coming, that maybe at that point there's 50 basis points more of cuts in the system. But as of now, it seems it seems more as sort of a front-loading ploy. There doesn't seem to be anything in the concurrent data to suggest that, yes, it shows that growth is soft, but it's not showing growth jump off a cliff. So it seems that it's more from the policy transmission side, which the RBI is looking at.
With this, we let you go on that. Thank you so much for taking the time out and speaking with us. All right, but with this, viewers, it's now time to slip into a very short break in this edition of First Trades. Don't go anywhere. We'll be right back with more on the other side.